Hey, how are you guys doing? I'm Kent Tilley and welcome to the channel. Today I want to talk to you guys about something. If you have a mortgage, I want you to check your paperwork to see if you're paying for something that you probably, don't need or want to replace with something that is way better. And this idea of this video came up. I was golfing with my men's league a couple weeks ago, a couple buddies of mine, and they were talking about on their mortgage how that's where they have their life insurance. And I was like, are you guys kidding? Like, is this a joke? I've golfed with you for like 7 years and I thought you had like good insurance, because I don't like talking to people about this stuff, when I'm doing things that are fun, and I just made a bad assumption. And, in the beginning when I started this career, mortgage insurance was absolute garbage. Since then, it's gotten better. However, there are drawbacks, so I want to talk about them. And when I talk about mortgage insurance, I'm not talking about CMHC and if you put, only 5% down, then you have to pay CMHC. I'm talking about the life insurance, the creditor protection that you add on to your mortgage and pay, maybe $100, $150, $200 for, or whatever it is a month, and you just sort of included it in your mortgage. We're like, yeah, obviously that's not a problem to pay an extra $90 a month. I already owe way more money than I'll ever be able to afford to pay back. So I want to talk about, and you're like, yeah, that makes sense. I should insure this giant purchase that I've made, and I get it. And on paper, it's not terrible. However, there is something better for you. So that's what I want to talk about today, is life insurance versus creditor insurance on your mortgage. And then I'll explain why the creditor insurance is actually good in one way, because I don't want to be completely unfair to it. However, if we're just comparing life insurance to mortgage creditor insurance, there's absolutely no comparison. You should have real life insurance every single time. Okay, so the first thing that you need to think about is how this product works. So you go into the bank or to your mortgage lender or whatever, and you take out a $500,000 mortgage, and you're 35 years old, and they say, okay, for an extra $80 a month, we're going to insure you on this mortgage. And you say, okay, that's not too bad. And if you die, the mortgage will be paid off. Now that's fantastic on the day that you bought it, but say 15 years later, now your mortgage value is down to say $200,000 left owing or something on the mortgage, whatever. You're paying it off aggressively. You only owe $200,000. You've still been paying that $80 a month. You die and just the mortgage was paid off. And so that insurance was worth $200,000 15 years out. Where you could have bought a term 20 policy, for example, for $500,000 at the start of taking this mortgage for say $30 a month or something like that. And all of the sudden, when that, pays out, something bad happens to you or your spouse, all of a sudden they get paid out $500,000, pay off the $200,000 mortgage, and are left with $300,000 to do with whatever they want. They don't even necessarily need to pay off the mortgage if they don't want, because you actually have the choice, because that protection is for you instead of the lender knowing that they're going to get that paid out. So that's the thing, as the mortgage value goes down, so does your insurance, but your premiums are staying the same. So that part of it sucks. Like, that part is sort of a no-brainer that you should switch, especially since like the life insurance that you can get personally should actually cost less than that life insurance and is worth more. Another thing to think about is that this doesn't always pay out. However, life insurance is a guaranteed contract beyond the 2-year incontestability period. So if you were fraudulent in your application or you committed suicide within 2 years, they can look back if you died within 2 years and say, maybe we won't pay this out if we found that this person was actually lying to us or committed suicide. Otherwise, after that fact, it will just pay out absolutely no matter what, because you signed this contract with them and went through the underwriting process with the insurance company and your insurance agent. Say that was us. With mortgage insurance, they ask you a few questions, but they do not underwrite at the time, only other than basic underwriting. And they say, yeah, we would probably insure this person because, they say they don't have cancer right now or whatever. But if you died, that's when they're going to go back and decide whether or not they would have actually insured you at that particular time. And so if they find anything from your past when you signed those mortgage papers, they could say, actually, you know what? We don't want to pay you because we didn't know that you had, whatever, history of heart disease or something in your family. It doesn't happen all that often, but it does happen. And you hear the horror stories of people not getting their mortgage paid off because the insurance company with the lender was like, no, we're not going to pay this off. So it's not as guaranteed as it seems. And then another huge thing that sort of maybe doesn't get talked about enough with this is look at how often you move or move lenders, chasing rates, doing these things, saying, yeah, I don't like that bank anymore. I want to go to this bank, or I have a friend that's a mortgage broker over here and they can get me a better rate when my renewal comes up. And obviously you want to save that money. And so what's going to happen every time you renew that mortgage, all of a sudden you need to renew that mortgage insurance or that creditor insurance. And that's 5 years from now, or 5 years from the last time that you actually did this. Maybe now you're 5 years older, you've run into some health issues, and maybe now you're no longer insurable. All of a sudden you have absolutely no insurance because you thought you were covered when you were young and first bought your house. So this might lock you into having to stay with the same lender, renewing that mortgage that maybe isn't as favorable the whole time, could end up costing you an awful lot of money, instead of just declining that and saying, no, I have my own personal insurance that is going to more than pay off this mortgage and take care of my family in other ways if I pass away. Because sometimes just the mortgage insurance or having just the mortgage paid off isn't actually going to be enough, because maybe your spouse doesn't work, they need actual money other than just being mortgage free in order to live that lifestyle, potentially retire, all of these other things. So those are the main issues as to why I would say, look at this and then talk to, a CFP that is also an insurance agent. Don't go and talk to an insurance only agent, because those are where you're going to fall into nightmares and be sold a product for, like $300 a month that isn't even good insurance for your needs, because they're just trying to generate a big commission off of you. Now, the one thing that is generally good about the creditor insurance is that generally there is some disability component involved in that. And so obviously disability insurance is a different animal completely. It's harder to get, approved for it. There are a million different policies you can get depending on your occupation, depends on a whole bunch of other things. And what this generally does is it says, if you get injured, can't work, we declare you disabled, then we'll pay your mortgage payments for X amount of years. Generally, it's, say, 2 years. Sometimes there's also a critical illness component in there. I don't know if they do it anymore, but TD used to have one that was like, if you get a critical illness, we'll pay off your mortgage. And I was like, Nobody can compete with that. That's an actual amazing product if you got a critical illness and they just paid off your mortgage. I doubt that they do that anymore. So it's not comparing just replacing the life insurance with the life insurance, because in every case it would basically cost less just to get that same amount of life insurance for the term of your mortgage, rather than paying the creditor insurance. So that is part of the conversation that you need to have as well before replacing it. But I basically think in every single case where you are paying for creditor insurance on your mortgage, that it is worth a conversation. And that's a conversation that we'd obviously be happy to have with you. I mean, we're all licensed insurance agents. We believe in insurance. We never believe in overselling insurance. We just want to make sure that our clients are covered, Canadians are covered, they're not being sold something they don't need. And there's always a way to sort of fit insurance in a budget to make it work for pretty much everybody. So if you want to, please reach out to us at info@k4financial.ca. We'd be happy to talk to you about your needs, run some quotes for you, and see if there's some better options for you out there. So again, thank you guys very much for watching. Hope you learned something, and if you did, please like and subscribe, and we'll see you again very soon.